Would you rather watch your portfolio double or receive a steady stream of passive income? That's the real difference between the ETFs we are covering today. If you had to pick just one ETF for 2025, which would it be? SPY or SCHD? SPY gives you the biggest companies in the US, packed with high growth stocks. SCHD, on the other hand, focuses on steady, dividend paying businesses. Two completely different investment styles. But which one actually makes more sense for 2025? That's what we're here to find out. In this video, we'll cut through the noise and compare SPY and SCHD based on real numbers, returns, volatility, dividends, and long-term potential. No fluff, no opinions, just facts. By the end, you'll know exactly which ETF fits your investing style and where the market could be heading. So if you're thinking about where to put your money in 2025, stick around. Chapter 1. Overview of SPY and SCHD. Before we compare them, let's quickly understand what SPY and SCHD actually are. SPY, or the SPDR S&P 500 ETF, is one of the oldest and most popular ETFs in the world. It tracks the S&P 500, meaning it holds the 500 largest US companies. Think Apple, Microsoft, Amazon. Big names, big growth. When the stock market goes up, SPY usually follows. But when it crashes, SPY drops too. SCHD, or the Schwab US Dividend Equity ETF, works differently. It doesn't focus on just any big company. It looks for businesses with strong profits and consistent dividends. SCHD holds around 100 stocks, mainly from sectors like finance, healthcare, and consumer goods. Companies like Pepsi, Home Depot, and Cisco. These stocks may not grow as fast, but they pay solid dividends even in rough markets. So in simple terms, SPY is about growth. SCHD is about income. One rides the highs and lows of the market. The other aims for steady returns with dividend payouts. But which one performs better? Which one is safer? And which is the smarter bet for 2025? Let's compare them head to head. Chapter 2. Performance Comparison. And see which ETF actually performs better? Let's start with historical returns. Over the past 10 years, SPY has delivered around 12% average annual returns. That's because it's loaded with high-growth stocks, especially in tech. When companies like Apple, Nvidia, and Microsoft go up, SPY benefits massively. SCHD, on the other hand, has averaged around 10% per year. It's a solid return, but slightly lower than SPY. That's because dividend-paying companies don't grow as fast as tech stocks. However, SCHD's returns come from two sources: price appreciation and dividends. Now, what about dividends? This is where SCHD shines. Right now, SCHD has a dividend yield of around 3.5% compared to SPY's 1.3%. That means SCHD pays you more in cash flow, which can be reinvested or used as passive income. But let's talk about risk. SPY can be volatile because it depends heavily on tech stocks. In 2022, for example, SPY dropped over 18% when the market crashed. SCHD, however, only fell around 3% in the same period. That's because dividend stocks tend to be more stable, especially during market downturns. So, here's the key takeaway. SPY wins in total growth. SCHD wins in dividends and stability. But what does this mean for 2025? Well, that depends on market conditions. If tech continues to boom, SPY could outperform. But if markets remain uncertain, SCHD's stability might be the safer bet. So, which ETF fits your investing strategy? Let's break it down further. Chapter 3. Expense Ratios and Fees. Costs, because fees matter. Even a small percentage can eat into your returns over time. SPY has an expense ratio of 0.09%. That means for every $10,000 you invest, you pay $9 per year in fees. Not bad for an ETF that gives you exposure to 500 top US companies. But SCHD is even cheaper. Its expense ratio is only 0.06%. So for every $10,000 invested, you pay just $6 per year. That's 33% lower than SPY. Now, this might not seem like a big difference, but over 10, 20, or 30 years, lower fees can add up, especially if you're reinvesting dividends and compounding returns. So in this category, SCHD is the clear winner. It costs less to own, which means more money stays in your pocket. But let's move beyond fees and talk about volatility and risk, because that's where things get interesting. Chapter 4. Volatility and Risk. SPY is tied to the S&P 500, which means it moves with the overall market. When the market is booming, SPY soars. But when things go south, SPY drops hard. In 2022, for example, it fell over 18% when interest rates went up and tech stocks crashed. SCHD, on the other hand, is built differently. It focuses on dividend-paying companies, which tend to be more stable. While SPY was down 18% in 2022, SCHD only dropped around 3%. That's a huge difference. Why? Because dividend stocks usually belong to established, profitable businesses. These companies aren't chasing high growth. They focus on steady cash flow. That makes SCHD less volatile than SPY. So, what's the trade-off? Well, lower risk often means lower growth. SPY has the potential for higher long-term gains, but it also comes with bigger swings. SCHD is safer, but it might not grow as fast in bull markets. So, if you want faster gains and can handle the volatility, SPY might be better. But if you prefer stability and lower risk, SCHD is the safer bet. Chapter 5. Which ETF is better for 2025? Alright, now for the big question. Which ETF wins in 2025? The answer depends on where the market is heading. If tech stocks continue to dominate, SPY could be the better choice. The S&P 500 is heavily weighted in tech giants like Apple, Microsoft, Nvidia, and Amazon. If these companies keep on growing, SPY's price will likely climb higher. But if the market struggles or if interest rates stay high, dividend stocks might be the safer bet. That's where SCHD shines. Even in tough times, SCHD's dividend yield of around 3.5% keeps paying investors. And historically, dividend-paying companies hold up better in downturns. So, who should pick SPY? If you want higher growth and can handle volatility, if you believe tech will keep leading the market, and if you're investing for the long term and don't mind short-term dips. And who should pick SCHD? If you want stability and consistent income, if you prefer lower risk, especially in uncertain markets, if you're looking for strong dividends to reinvest or use as cash flow. Another thing to consider, you don't have to choose just one. Some investors combine SPY and SCHD for a balance of growth and stability. That way, you get exposure to be the best performing sectors while also collecting solid dividends. At the end of the day, it all comes down to your strategy and risk tolerance. Want faster gains? SPY. Prefer stability? SCHD. So, which one fits your portfolio best? Well, there's no one-size-fits-all answer. It depends on your goals. If you want growth and don't mind some volatility, SPY is a strong choice. It tracks the S&P 500, giving you exposure to top US companies and high-growth sectors. But if you prefer stability and dividends, SCHD is the way to go. It focuses on high-quality, dividend-paying companies that offer reliable income and lower risk. Now, here's something to think about. Why not both? Some investors split their portfolios, using SPY for growth and SCHD for stability. That way, you get the best of both worlds. At the end of the day, the choice is yours. But whatever you decide, make sure it aligns with your investing style and risk tolerance. So, which one do you prefer? Let me know in the comments.